Good morning. Welcome to the XM.com weekly market update, and we're joined again by Peter McGuire, the CEO of XM Markets. Morning, Pete.
Good morning, Andrew.
Well, plenty going on.
Understatement of the century.
Understatement. The Swiss have stepped up to grab the limelight.
Yeah, absolutely. Credit Suisse. And I think there was an article in the, or not an article, front page of the Financial Times on the weekend, and 460 billion wipeout for banks globally last week. So I think as far as the Swiss were concerned, they had to rescue, and there was no backward step with Credit Suisse.
No, I don't think so, no. So we'll get a bit to that a little bit more later. First of all, locally, not a huge amount out in the domestic market. The NAB business confidence came out, a negative number, but that number jumps around a little bit, but the negativity is not unsurprising considering the local conditions.
Exactly. Yep. The chart tells a story, and I think everyone can appreciate that.
Yeah, you've got that chart, and then we've got the employment chart, which the labour market in most developed countries is holding up extremely well.
Very, very well. Tech sector's being wiped out, but certainly the majority of people, the greater majority, have got a job. If they want a job, they'll get a job. Wage rises are another matter, and that's the greatest concern to inflation, because you need to see a wipeout as far as employment to bring inflation down, and with full employment, that's every central banker's biggest nightmare.
Yeah. And you wouldn't think with these strong labour numbers, and they're really hanging in there, the likelihood of a recession where you've got full-time employment is unlikely.
Yes, it is unlikely, and I'm not sure how this plays out. We're not through the first quarter yet, let alone the fourth quarter of 23. So it's going to be a fascinating next 3 quarters.
Yeah, it's a really interesting dynamic compared to sort of tougher times in years gone by, where everything sort of the dominoes tended to line up, whereas currently it's a bit all over the shop, as in the data coming out. So it's really hard to get a pick on which way it's going to head.
Yeah, exactly. All I know is it's incredibly volatile, and that's what traders want.
In the UK, we've got the Bank of England meeting this week to probably put up interest rates again. So you got the CPI coming down ever so slightly, but it's the story there is that the real wage growth, growth is not the word because it's going backwards.
Yeah, exactly. That's just a big wipeout, and the differential between those two numbers are catastrophic for the consumer.
And that's nearly 2 years worth of data there of negative wage growth, really.
Yeah, and inflation growing, compounding year on year, that yearly CPI number. So how that rolls, we've got 3 central bankers or 3 central banks meeting this week, as you mentioned, the POMs. We've got Jay Powell and his gang, and the Swiss. So let's see where we all roll, but I think it's going to be fun times ahead for the bond market till the end of the month.
Certainly will be. A couple of charts on gold. Gold, not surprisingly, has been the flavour of the fortnight.
2 weeks ago was 1810. Now it's 2010. I spoke yesterday with CNBC and it was 2010. I think it's right on 2000 as we speak. So it's had an enormous rally, absolutely on fire, and up around about 11.5% in that 10-day window. That's just magnificent for traders. Look at that. That's parabolic on that chart.
It's certainly shot up, hasn't it?
Yeah, we're about, I'm not sure what our all-time high is, but we're at 2010 yesterday. I don't think we're too shy from it. No. I'm not sure if it was 2070 or 2050. I'd have to look. Can't recall that number, but with the silver's been an incredible standout as well. So let's just see what happens with US dollar and bond markets. Yeah.
Speaking of the bond market, so you can see this is an interesting chart in a couple of ways. Obviously, just the correlation between the US 10-year as well as gold.
Yeah.
They follow each other. Obviously, there's a bit of a divergence there at the moment, but you're right. The 10s have come off about half a percent since 10 days ago.
Yeah.
On the back of the bank crisis. But yeah, it just gives good indication there of how they track one another.
Well, you keep on saying, and this is an education process. That's what we're trying to do, is educate our traders and the global audience by, talking every week together. But you're, great experience with Bloomberg, and you're very bond-centric. You keep on saying bonds, they drive, and they do, and this is what traders need to be conscious of. Have your screens open. Look at your 10-year and your 2-year for US Treasuries. See, that's got to be one screen. Then you've got your other composition of screens. Some people, as you know, you're at Bloomberg, some people have got 10 screens on a desk. if you're trading multiple markets, they're not expensive hardware, $100 a screen these days, and you hook them in, and then all of a sudden you're setting up your trading room and you're looking at all those key components. You've got your news on. There's Bloomberg beaming through with world commentary, and that's what you've got to be taking on board, your technical analysis, but more importantly, what's happening with your fundamentals, and then reading into that. This is a big business. I mean, these, you know, it was in a mention the other, I think, in the last couple of months from our global CEO. We're turning over $1 trillion a month. That's enormous with a global audience. So, you know, that's the attraction, I think, with these markets, Andrew. They are truly global for male and female all over the world.
Yeah, it's hard to get your head around some of those numbers, isn't it? It's massive. So
24 hours a day, it doesn't sleep.
That's right, yeah. So let's head to the US where all the activity is. The CPI has once again come down a little bit. It is falling slowly, but it is falling. Whether or not the events of the last couple of weeks will kick that off a bit more, time will tell. But once again, we've got the Fed this week.
Jay Powell tomorrow.
The most likely outcome at this stage is probably a 0.25% increase.
80% probability. That's what they're all saying. We're moving on the back, of course, with the ECB last week at 50 basis points, the European Central Bank. At 20% probability that we'll see no movement from the Fed. But I'm on your side. I'm certainly in the 80% camp that 25 basis points is pretty much baked in.
And if we look at the Fed rate as well, it's interesting here that blue line there is what the anticipation for Fed rate was going to be a few weeks ago.
Yep.
The green line is now what they're thinking, and there is a huge difference there.
Yeah, absolutely. I mean, you've got to be up to speed. You can't take 2 weeks off trading and jump back in and go, oh, okay, what's been happening? Oh, nothing. You have to look at this as a 24-hour window and do your readings. You know, you're putting your hard money at work, make sure that you're up to date. And there's a classic example. I mean, you know, before crises, after crises, and this is global. This is all central bankers.
Right. Well, they've had plenty to do in the last couple of weeks.
They've been a busy team.
So
far better them than us.
Yes, they've certainly stepped up to the plate. Moving on to the next slide, the final slide there is, once again, we had a similar slide last week, which just gives us a good view of both the 10-year Treasury and the 2-year. So obviously that spread has come in considerably over the last couple of weeks, but that 2-year rate, now the 2 and the 10s have crept up a little bit overnight because there seems to be a little bit of stability in the market, but those 2s, that is still basically 1% lower than what it was about 2 weeks ago.
2 weeks. So isn't it interesting? 2 weeks ago, we were here on the Tuesday, and it collapsed that night, that morning before we got here. So it was Monday night, US time. Gold was at 18.10. Bonds got smashed. Gold's now, you can see the chart, and gold's up 12%. It's just, there's the correlation.
Yeah, that's right. So, and once again, depending on, you would think once we get a bit of stability back in the markets, you would suspect these rates might creep up a little bit, but you know, you just never know what's around the corner.
No, we're going to see, I mean, equities, and Friday was so-so. Last night ended in US equities were up. Yesterday across Asia was a pretty poor day. There was no shining lights. But today we're off, and I think we're up about 0.6. And it's, 20 past 10 on Tuesday morning, the 21st. That's Sydney time. So we're up so far, but the market's been open 20 minutes in Australian equities.
Yeah. So, but I think the rest of the week, obviously, it's going to be around the 3 central banks, the interest rates, see where they land, to give us some guidance on what happens in the coming weeks.
Yep, and I want to keep a close eye from a trade perspective. Crude's coming under pressure to the downside, continued sell-off, and I want to see where gold is. Goldman came out, I did some TV yesterday, and they said, Goldman's revised its forecast for crude to $95. And I said, well, that's fine. That's this year, but we're not through the first quarter yet. I want to see where we are as far as a bottom to crude. Then you can see some form of reversal, because at the moment it's still coming down. Let's not worry about 95, it's at 65.
Yeah, so plenty to play out, that's for sure.
Oh yeah.
All right, thanks again, Pete.
Good to see you, Andrew.
See you next week.
Look forward to it.
Great, excellent. And that's the xm.com weekly market update.